Joining us now, Crossmark Global Investments Chief Market Strategist Victoria Fernandez. Victoria, good to speak with you this morning. So you're certainly not on board with this idea that we're going to rush to easing by the Fed. But how does that play into your overall outlook for the markets and the economy?
Yeah, so based on the conversation that you guys are just having, I mean, you're right. Look, we've got earnings expectations for 2024 that are double digits, right? It's 11%. You've got revenue growth expectations over 5%, GDP expectations going higher. So it's hard for us to look at that and say that's the type of environment when the Fed is actually going to start cutting rates. I know you talked about inflation being the key number for the Fed to be watching, but I think even if you continue to get disinflation, but the economy is holding up in regards to consumer spending, in regards to GDP growth, again, I don't think the Fed is going to be in a rush. I think it's going to take some kind of a trigger or a mild recession to get the Fed to start cutting rates. That trigger's probably going to come from the labor market. We got labor market news this morning. We saw the jolts come down. That kind of works along the storyline of the economy starting to slow down. That's where I think people need to be focused to see what the Fed's going to do. We do expect to see some kind of a mild recession or a pullback as we go or around the, second quarter, middle of 2024. That's when I think the Fed will start to act.
Granted, Victoria, it does seem tough to have it all, essentially, good economic and profit growth and perhaps easier policy from the Fed. However, I did happen to look back to the year 1995, which is the classic perfect soft landing scenario. S&P earnings growth, 10.5%, nominal GDP growth just over 5%. The Fed trimmed rates 2 or 3 times, really no big deal, but more or less sort of acknowledged that inflation had been beaten. So there is some precedent, perhaps?
There is some precedent, Mike, but I think you also have to look at some of the other soft landings that were achieved when you look at 66, 85. Again, looking at 95, the environment was very different. Banks were actually easing their lending standards, not tightening their lending standards like they're doing now, because delinquencies or credit card delinquencies are up, tighter lending standards, less loan growth. We actually saw in the third quarter real revenues decline, not nominal, but real revenues come down in the third quarter. So there are some things that are different than what we saw in the last soft landing. And I think you have to take that into account, that the environment could position itself for maybe a little bit more of a harder landing than what people are expecting, and the market's getting a little bit ahead of itself.
I feel like what ultimately matters is what's happening with treasuries, Victoria. And this morning we're at 4.1 on the 10-year note yield. I wonder how much downside you see and what that will mean for equity performance.
Sarah, I'm so surprised at the level or the pace that we've seen these yields come down. I mean, third week of October, we were north of 5% on the 4-year. So we're down 80, 85 basis points, 90 basis points in such a short period of time. Granted, you look at some of the things and you can say there's short covering. I mean, you look at the open interest along that time period, and that's come down a lot. There's been a lot of short covering. People are trying to get some income, and they're coming in there. There was less concern around demand at the auctions. So there were some reasons for yields to come down, but I think maybe it's a little overdone at this point. I wouldn't be surprised to see yields go a little bit higher once we start bringing out the January or the March rate cut that the market's anticipating. That's going to have to be priced back out of the market, in our opinion, and we'll see yields go back up, probably settling around that, 430, 450 as a trading range.